Right now, the market feels confusing. You've got oil prices pushing higher because of geopolitical tensions, inflation risks starting to creep back into the conversation, and at the same time, currencies like the Japanese yen are under pressure again. And if you've been in this space for a while, you've probably seen people jump straight to the same conclusion: Japan intervention, currency crisis, global markets at risk. But here's the thing: if you frame this just as another Japan story, you're missing what's actually happening underneath. Because this isn't really about the yen, it's about energy. And more specifically, it's about how rising oil prices are feeding directly into Japan's economy, creating inflation pressure at exactly the same time their financial system is least equipped to deal with it. So, in this video, I want to break this down properly. What's actually happening with oil, how dependent Japan really is on energy imports, how this feeds into inflation, and then get into the bigger question: whether there is a realistic way out of this, or whether Japan is stuck managing pressure rather than solving it. And if you're new here, my name's Paula. This channel is all about breaking down what's really happening in crypto and global markets in a way that actually makes sense so that you can stay ahead instead of just reacting late. To understand why this matters, you have to start with how dependent Japan is on energy imports. Japan imports roughly 90% of its total energy needs. And when it comes to crude oil, over 90% of that supply comes from the Middle East, primarily countries like Saudi Arabia and the United Arab Emirates. That level of concentration is important because it means Japan is highly exposed to any disruption or price movement coming out of that region. So, when oil prices rise due to geopolitical tensions, Japan doesn't just feel it gradually, it feeds directly into the cost of running the entire economy. And because oil is priced globally in US dollars, there is another layer to this. When oil prices rise at the same time as the yen is weak against the dollar, Japan effectively gets hit twice. The global price of oil increases, and then the cost rises again when it's converted back into yen. That combination pushes up import costs across the entire system. Energy bills increase, transport costs rise, manufacturing becomes more expensive, and food distribution costs climb. This is how inflation is being created in Japan right now. It's not being driven by strong domestic demand in the way you might see in other economies. Instead, it's being imported through energy and currency dynamics. The Bank of Japan has already reflected this in its outlook. It's raised inflation expectations while at the same time lowering its growth outlook, which is a classic sign of cost driven pressure. High input costs reduce profitability for businesses and squeeze household incomes even as prices rise. At the same time, Japan is also dealing with a shift in its bond market. Government bond yields have been moving higher compared to the levels Japan has experienced for decades. While these yields are still relatively low compared to other countries, the change itself is significant. Japan's financial system has been built around ultra low interest rates and stability in borrowing costs. Even a modest rise in yields can introduce stress into that system. This is why it creates the policy tension for the Bank of Japan. Normally, if inflation rises, central banks increase interest rates to bring it under control. But in Japan's case, raising rates too quickly risks destabilisation of the bond market. On the other hand, if rates remain low, the yen stays weak, and that continues to push up the cost of imports, which feeds inflation further. This is why currency intervention becomes part of the conversation. Japan has intervened before by selling US dollars and buying yen in order to stabilise its currency. This happened in 2022 and again in 2024, where tens of billions of dollars were used during periods of rapid yen depreciation. However, it's important to understand how intervention works in practice. Japan rarely confirms intervention in real time. Instead, actions are typically taken quietly, and confirmation only comes later through official data releases. When we see sudden and sharp movements in the yen, there is often speculation about intervention, but it's not always immediately confirmed. What is confirmed is that Japanese officials have repeatedly stated they are ready to act if currency movements become excessive. What remains uncertain in real time is the scale and timing of those actions. This distinction matters because while intervention can influence short term movements, it does not resolve the underlying economic pressures. There's also a limit to how effective intervention can be. The foreign exchange market is extremely large, with daily trading volumes estimated at over $7 trillion. Japan has substantial foreign exchange reserves, but they're not unlimited. That means that intervention can slow or temporarily reverse currency movements, but sustaining that impact without broader changes in global conditions is difficult. This is where the role of the United States becomes relevant. The strength of the dollar relative to the yen is heavily influenced by the difference in interest rates between the two countries. US interest rates have been significantly higher than Japan's, which has encouraged the carry trade, where investors borrow yen and invest in higher yielding US assets. If US interest rates were to fall, that gap would narrow. A smaller gap reduces the incentive for the carry trade, which in turn reduces pressure on the yen. In that sense, a shift in the US monetary policy could help stabilise the yen without requiring as much intervention from Japan. This is why some analysts have started to consider whether the US could indirectly ease Japan's situation. The idea is not that the US would actively step in to rescue Japan, but that changes in US policy could have a stabilising effect on global currency dynamics. However, this depends on inflation in the US continuing to fall. If inflation remains elevated, particularly due to rising energy prices, the Federal Reserve may keep interest rates higher for longer. In that scenario, the gap between US and Japanese rates remain wide and pressure on the yen continues. There's also the possibility of coordinated intervention. Historically, coordinated action between major economies has been more effective than unilateral moves. If the US Treasury were to support Japan in stabilising the yen, the impact would likely be stronger and more sustained. However, significant coordination is rare and typically only occurs during periods of significant market disruption. At present, there is no confirmed coordination intervention, although communication between policymakers does take place. When you bring all of these elements together, what you see is not a simple currency story. It's a combination of energy dependency, imported inflation, shifting interest rate dynamics, and the structural changes in the bond market. These factors are interacting in a way that creates pressure from multiple directions at once. For global markets, this matters because Japan has historically been a major source of low cost capital. The carry trade has supported investment flows into global assets, including equities and crypto. If that dynamic changes even slightly, it can influence liquidity conditions worldwide. Crypto, in particular, is sensitive to liquidity. When financial conditions are loose and capital is flowing, crypto tends to perform well. When liquidity tightens, markets become more cautious and risk assets can come under pressure. This does not mean that Japan's situation will directly cause a specific move in crypto, but it does mean that it's part of the broader environment that shapes market behaviour. At the same time, it's important to recognise that Japan does have tools available. The government can use subsidies to limit the immediate impact of rising energy costs on households and businesses. Strategic energy reserves can provide short term supply stability. Over the longer term, Japan is working to diversify its energy sources, including restarting nuclear reactors and expanding renewable energy capacity. There are also multiple possible paths forward depending on how global conditions evolve. If oil prices stabilise, inflation pressure could ease. If US monetary policy shifts, the currency dynamic could change. If markets adjust gradually, the situation may remain manageable rather than becoming disruptive. So, the key takeaway is not that Japan is heading towards a crisis, but that it's navigating a complex set of pressures that are closely linked to global energy markets and financial conditions. The situation is fluid, and outcomes depend on how these different factors evolve over time. If you found this helpful, make sure you like, subscribe, and let me know in the comments. Do you think rising energy prices become the real driver of the next market move? Or do you think this stabilises before it spreads further? And as always, remember to join me and Milkshake Matty on the UK Crypto Podcast. We drop new episodes every Friday, 7 p.m. UK time, right here on YouTube and also on Spotify. Thank you so much for watching, and I'll see you on the next one.